Hi guys, I wanted to record a quick video, so I didn't get much time in May to record any videos again because I was extremely busy. But I basically want to show you how to catch higher risk to reward trades or get a bigger reward per trade, and keeping the risk obviously similar. So let's say for example you're looking at your 4 hour. So you're looking at your 4 hour. Okay, so if you wanted to trade off and you see a 4 hour demand over here, okay, so let's say you wanted to buy on the demand, and it's about 40, so let's make it, let's just round it off, make it 50. Okay, there you go. Okay, so let's say your TP was 50 pips, and let's say this for argument's sake your SL was below the previous low, so 10 pips. Obviously usually if you're going to trade off the 4 hour, your SL will be much bigger, like 30 pips, 40 pips. But in this case, it will be, you'll have a risk to reward of 4.8. Okay? So, which means you're risking 1% on that 10 pips to make 4.8% on the 50 pip move. So, but what you should actually be doing is using the 4 hour and the daily, weekly, monthly, obviously for your bias, but we don't enter off the 4 hour. So obviously within the 4 hour, this is basically the moves within the 4 hour. So it'll be something like, hang on. Okay, so obviously the market won't always be moving this clean. Okay, so if this is a 4 hour and you go down to the excuse me, and you go down to the 15 minute, 5 minute, this is obviously how the market will be looking, okay, within each of these waves in the market. So what you'll do is you'll go down to the 15 minute. So let's say this is your 4 hour. And then within this move, there's your 15 minute or 5 minute. Okay, so you will use your 4 hour demand zone and look for the 15 or 5 minute or 1 minute demand zone. Obviously rather stick to the 15 or 5 minute when you do refine your demand and supply zone, because on the 1 minute there's a lot of fake outs, a lot of noise, as you saw how it would be looking. There'll be too much moves and will confuse you. And you don't want to decrease your win rate. Okay, so on the 15 minute, let's say It's going. Come on. Okay. So let's say within this move, okay, this move over here, you found your demand or supply zone on your higher time frame, but now you go down to the lower time frame, which is your 15, 5 or 5 minute. Okay, now you see this. Okay, so what I'm using is, let's say, from this, between these two blue zones, okay, let's say that's this, and well, let's say this, let's take it to the peak. Okay, so this on the 4 hour is this on the 15 or 5 minute. Okay, okay, so obviously you have the demand zone. Now you're gonna go to the lower time frame and find the same demand zone and refine it. So it'll be, let's say you put your demand zone like this. Because it's under 15 minute, you can obviously make it a bit smaller. Or the 5 minute, you can make it your stop loss a bit smaller. So you'll basically be getting a sniper and a tighter stop loss. So let's say you entered like this. You can just also make it 50 pips. I want to get this the same size. Okay, let's just say it was, so your TP is still the same size, but you refined your entry or your demand zone to a lower time frame. So let's say you went to the 15 minute and you got it down below the previous low. You got it down to 5 pips. So same TP, okay, 50 pips. Same movement in the market, okay, with a tighter stop loss. Okay, so this 50 pips gave you 4.8%, where this TP gave you 10%. So that's how you will find basically higher risk reward trades on the same setup, but refining your stop loss to be a bit smaller, but with a higher risk reward. And obviously, I did explain in the previous video, obviously a demand or supply zone is usually, let's just take this, it's usually a sideways movement. So you don't trade off the sideways movement, you know. We don't trade a ranging market. You only trade Once it retests it, okay, and comes back, then you'll trade off that. Okay. Obviously within a 4 hour, wow. Okay, so within a 4 hour candle, or 4 hour demand supply zone, you will find a 15-minute. It's indefinitely you will find a 15-minute or 5-minute demand supply zone. Okay, that looks a bit better. You will find a zone, and obviously you can, depending on the time frame, obviously if it's a candle like this, you'll just use the body, or you can use your 50%, and then just over here. So this from the top of the candle, whether of the low of the wick and the high of the body, where the body closes like that. But it'll obviously be depending if it's a bullish or bearish market. If it's a bullish market, this will be a bearish candle. Okay, so let's say in a bullish market, the demand zone will be a bearish candle. Okay, it'll be obviously bearish candles, little bull, and another bearish candle. So it's a large bearish candle before the move up. That's basically your demand zone. I did explain it in the previous breakdown videos as well, for reference. In the bearish market, your supply zone will be the last bullish candle. Before the down impulse. So the bearish market supply zone will be the last bullish candle before continuing or impulsing bearish. In the bullish market, the demand zone will be the last bearish candle before impulsing bullish. And also, obviously, a demand supply zone is also referred to as an order block.